It's 1929, and America is in the midst of one of its greatest financial booms. The stock market is soaring, unemployment is low, and the future seems bright. However, beneath the gleaming surface of prosperity, there are cracks. Cracks that, if ignored, could lead to an economic collapse that would shake the world for decades to come. We'll explore the environment leading up to the fateful day of October 29, 1929. And uncover the overlooked financial signals that foreshadowed the greatest stock market crash in U.S. history. The question is, why did no one see this coming? The Roaring Twenties, a time of rapid economic expansion, jazz music, and flapper dresses, was also a time of unprecedented financial activity. The stock market was seen as a surefire way to make money, and almost everyone was jumping in. If you had money, you were investing, and if you didn't, you were borrowing to get in. At the core of this economic boom was the rise of industrialization. Big companies like Ford, General Electric, and U.S. Steel were seeing massive growth, and their stock prices reflected this. American corporations were reporting record profits, leading to an increasing demand for their stocks. This optimism was not just restricted to Wall Street. It had become a nationwide sentiment. But was this success built on sustainable growth, or was it a house of cards waiting to collapse? Let's talk about leverage, a key concept in finance that was not fully understood by most investors in the 1920s. By definition, leverage is using borrowed money to increase the potential return on an investment. In the years leading up to the crash, more and more people were borrowing money to buy stocks. This practice is called buying on margin. In 1929, margin debt reached an all-time high. People were taking out loans from brokers to buy stocks, and they only needed to put down a small portion of the stock's price as collateral. The rest was borrowed money. The risks, however, were immense. If the stock market fell, they could lose everything, and many did. Yet, the mania continued. More and more people jumped on the bandwagon, and the market soared to dizzying heights. But there was a critical flaw. The market had become inflated, and it wasn't based on solid economic fundamentals. One of the critical indicators that something was wrong was the disconnect between stock prices and real economic activity. Corporate profits were high, but so were stock prices. In fact, they were becoming increasingly disconnected. Companies were being valued at much higher prices than their earnings could justify. Let's take a look at one of the most well-known companies of the time, Ford Motor Company. Ford was highly profitable, but its stock price had risen far beyond what its earnings could support. This was happening across many industries, but the belief in the unrelenting rise of stock prices was so widespread that no one questioned it. Economic data started to show signs of trouble, but no one was paying attention. Unemployment rates were low, but wages were stagnating. Industrial production was not keeping pace with the stock market's rise. Yet, the public remained blind to these fundamental problems. Why? Because the stock market was on a steady climb, and everyone was getting rich. The market was not just driven by logic. It was driven by emotion. People were buying stocks because they thought they would keep going up. This emotional buying frenzy led to speculative bubbles, where people bought stocks not because they believed in the company's long-term prospects, but because they thought they could sell them for a profit in the short term. This is classic speculative behavior. The term irrational exuberance, popularized by economist Alan Greenspan, perfectly describes the psychology of the 1929 stock market. Investors were not concerned with the fundamentals. They were only concerned with making money fast. The greater the rise, the more investors wanted to get in, pushing prices even higher. There were warning signs, however, that the stock market was heading for disaster. One of the most significant was the rising volume of trading. As stock prices soared, more and more people were getting in, creating a massive increase in trading activity. In August 1929, there were signs that the market was becoming unstable, but they were largely ignored. When the market is rising rapidly, it's natural for trading volume to increase, but there's a point at which high trading volume becomes a red flag. In the summer of 1929, the stock market started to experience erratic swings. Investors were acting on emotions, creating wild fluctuations in stock prices. This type of volatility is often a precursor to a market correction. But instead of being cautious, people doubled down on their investments. The Federal Reserve, which serves as the central bank of the United States, played a key role in the events leading up to the crash. Throughout the 1920s, the Federal Reserve had kept interest rates relatively low, which encouraged borrowing and investing. However, as the stock market became more speculative, the Fed started to raise interest rates to cool down the economy. But was this enough? It's debated whether the Fed's policies were too slow or if they acted too late. As interest rates rose, investors were forced to borrow at higher costs. The impact of the Fed's policy was felt particularly hard by those who had bought on margin. As interest rates went up, margin calls began to trigger, causing many investors to sell off their stocks in panic. We saw that the U.S. stock market was on the brink of disaster, with speculative behavior and mounting leverage creating a dangerous mix. However, there were still a few months before the full crash of 1929. It was during these months that the first cracks began to widen, and the panic started to set in. September 1929 saw a dramatic increase in trading activity. But it wasn't the usual type of activity. The market began to behave erratically, with wild fluctuations in stock prices that caused alarm for many seasoned investors. By now, the stock prices were far out of sync with the underlying company's economic health. The speculative frenzy was getting out of hand. Investors, no longer driven solely by optimism, were starting to wonder if the bull market could continue. In response to the mounting concerns, the Federal Reserve raised the discount rate in the summer of 1929. The Fed's intention was to slow the market by making borrowing more expensive. This was a critical moment in the lead-up to the crash, and while it signaled the Fed's desire to maintain economic stability, it was like putting a finger in the dam. It was already too late. By late September, it became clear that investors were jittery. Margin calls became more frequent as investors scrambled to cover their positions. But instead of recognizing the early warning signs of a market correction, the public continued to hold on to their investments, either hoping that the situation would improve or unable to sell due to the panic surrounding margin calls. October 24, 1929 is the day that history remembers as Black Thursday. It was the first massive shock to the financial system, but no one realized at the time that it was only the beginning of the worst financial collapse in history. On that fateful Thursday, the stock market plummeted. The Dow Jones Industrial Average lost more than 11% of its value in a single day. The sell-off began early in the morning. Brokers, unable to handle the sheer volume of orders, were quickly overwhelmed. The massive sell-off triggered even more panic, as investors tried to liquidate their positions before they lost everything. At the heart of this panic were the people who had borrowed money to buy stocks on margin. When the market fell, they were forced to sell stocks at a loss to cover their loans. This created a vicious cycle, where selling begets more selling. The massive declines on Black Thursday were nothing short of chaotic. In the span of just a few hours, stock prices dropped at a breathtaking pace. Even the strongest companies in the market couldn't escape the bloodbath. What was once thought to be a strong market was suddenly revealed to be built on sand. The Federal Reserve, as the central bank of the United States, faced an enormous challenge. While it had raised interest rates earlier in the year, it was reluctant to step in directly to stop the crash. The Fed had already made its move by tightening credit, but its actions had failed to address the underlying issues that were driving the market down. In fact, the Fed's response to Black Thursday and the subsequent days of volatility was slow and ineffective. The public and investors expected immediate intervention, but instead, the Fed's actions appeared too cautious. It wasn't until much later that they fully recognized the gravity of the situation. At the time, the government was also unsure of how to handle the unfolding crisis. President Herbert Hoover initially attempted to reassure the public, insisting that the market would correct itself and that the economy was still strong. However, his reassurances did little to calm the fears of the American people. By now, the crisis was out of his control. But what many failed to recognize about Black Thursday was the role of human emotion in driving the market. The fear and uncertainty that followed the day's crash created a panic that couldn't be easily reversed. And this panic wasn't just limited to the stock market. It spread to banks, to businesses, and to the lives of everyday Americans. While Black Thursday was a shock to the system, it was on October 29, 1929, that the full-scale catastrophe unfolded. This day would come to be known as Black Tuesday, the day the U.S. stock market officially collapsed. On Black Tuesday, the stock market plummeted even further, losing nearly 13% of its value in just a single day. By the end of the day, nearly 16 million shares had been traded. a staggering number that shattered previous records. The sheer volume of sales was unlike anything ever seen before. What was even more troubling about Black Tuesday was the massive amount of margin calls that were being triggered. Many investors were unable to pay off the debts they owed, and brokers had no choice but to liquidate their holdings. This caused an even deeper plunge in stock prices. But the damage didn't end there. The crash wasn't just a stock market event. It had profound ripple effects on the entire economy. Businesses, no longer able to secure funding or operate at the same capacity, began to fail. Banks that had been heavily invested in the stock market started to feel the pressure. The economy began to grind to a halt. The aftermath of Black Tuesday set the stage for what would become the Great Depression, a decade-long economic struggle that would affect millions of people worldwide. In the days following the crash, the effects were immediate and devastating. As stock prices continued to fall, many Americans began to lose their savings. The confidence that had once fueled the boom quickly evaporated. People rushed to withdraw their money from banks, fearing that they would lose everything. This led to bank runs, where banks were unable to meet the demands of their depositors. Unemployment began to rise as businesses faced financial ruin. The industrial economy that had once been strong was now weakened by the collapse of the stock market. Farmers too were affected as agricultural prices fell, and many were unable to pay off their debts. The social impact was profound. Families who had once been wealthy found themselves penniless, and the American dream seemed to crumble. For the average citizen, life became a daily struggle as the country faced the harsh realities of the Great Depression. The stock market crash had set off a chain reaction, and the world would not be the same again. As we reflect on the events of October 1929, it's important to understand the lessons that could have been learned. The market had been signaling danger for months before the crash. Margin debt was at record levels. Stock prices were disconnected from reality, and the speculative behavior of investors was setting the stage for disaster. These were all signals that could have been addressed, but they were ignored. In today's world, the lessons of 1929 still resonate. In many ways, we are still operating in a financial system that's prone to the same types of speculative behavior and over-leverage that led to the crash. While we have learned some lessons, it's clear that the financial world remains vulnerable to the same forces that caused the crash of 1929. The stock market crash of 1929 was not just a one-time event. It was the start of a chain of economic events that would last for years. By the end of October 1929, the damage had been done, but it was only the beginning of what would become the Great Depression. The immediate aftermath of the crash was devastating. As stock prices plunged, millions of Americans lost their savings. People who had invested heavily in stocks found themselves financially ruined. But the true extent of the damage didn't become fully clear until the months and years that followed. Unemployment skyrocketed as businesses went bankrupt. The collapse of the financial markets led to a wave of business closures. Farmers were hit hard too. Agricultural prices fell sharply, leading to widespread poverty in rural areas. Many farmers were unable to pay off their debts, leading to foreclosures. In cities, factories closed, and the banking system was on the brink of collapse. One of the most significant impacts of the crash was the collapse of the banking system. Many banks had heavily invested in the stock market and had lent money to clients who were now unable to pay back their loans. As banks failed, depositors lost their savings, leading to a massive erosion of public trust in the financial system. The economic problems in the U.S. were further compounded by the Dust Bowl, a period of severe drought that hit the Great Plains in the early 1930s. This environmental disaster worsened the conditions for farmers and further deepened the national crisis. The agricultural sector, already weakened by falling prices, was now suffering from a lack of water and soil erosion. By 1932, the U.S. unemployment rate had risen to nearly 25%, with 1 in every 4 Americans out of work. For the average person, life had become a daily struggle for survival. The U.S. government's response to the Great Depression was slow and, at first, largely ineffective. President Herbert Hoover, who had been in office during the crash, initially tried to reassure the American people that the economy would recover on its own. He believed in the principles of limited government intervention and felt that the market would naturally correct itself. However, this approach was not enough to prevent the depression from worsening. By 1932, Hoover's popularity had dwindled, and Franklin D. Roosevelt, FDR, was elected president. Roosevelt's administration took a radically different approach. He introduced a series of economic programs known as the New Deal to provide relief to the suffering population, recover the economy, and reform the financial system. The New Deal included the creation of programs like the Social Security Act, the Civilian Conservation Corps (CCC), and the Works Progress Administration (WPA), which provided jobs for the unemployed. Roosevelt also established the Federal Deposit Insurance Corporation (FDIC) to protect bank deposits and prevent further bank failures. Most importantly, Roosevelt implemented banking reforms that required banks to undergo inspection before reopening. He also took the U.S. off the gold standard, allowing the Federal Reserve to have more flexibility in managing the economy. While these programs didn't immediately end the Depression, they helped to provide some stability and hope to the American people. They marked a shift in the role of the government, with more direct intervention in the economy to protect citizens and prevent further collapse. The Federal Reserve, in hindsight, had made several key missteps in the lead-up to the crash. Its decision to raise interest rates too late and its reluctance to intervene aggressively during the early stages of the crisis led to further damage. The Fed's delayed response contributed to the economic downturn and its prolonged nature. However, after the crash, the Federal Reserve took significant steps to prevent a repeat of the situation. It learned a crucial lesson about the importance of monetary policy in stabilizing the economy. The Fed began to adopt policies that allowed for more flexibility in times of economic distress. One of the major reforms was the Glass-Steagall Act of 1933, which separated commercial and investment banking to reduce speculative risk. In the decades that followed, the Federal Reserve became more active in regulating the financial markets and managing the economy during crises. The lessons from 1929 would play a critical role in shaping monetary policy for the rest of the 20th century. While the Great Depression began in the United States, it quickly spread to other parts of the world. Countries that were dependent on the U.S. economy, particularly in Europe, were hit hard by the collapse of the U.S. stock market. Many European countries, still reeling from the aftereffects of World War I, found their economies in shambles. The U.S. was no longer able to lend money to these countries or buy their goods, further deepening the global crisis. By the early 1930s, most of the industrialized world had fallen into a severe depression. In Germany, the economic hardship caused by the Great Depression played a significant role in the rise of Adolf Hitler and the Nazi Party. As unemployment soared and the Weimar Republic crumbled, many Germans turned to extremist political movements for solutions. In Latin America, the economic downturn led to political instability. Countries that relied heavily on exports to the U.S. were forced to make significant adjustments in order to survive. Many of these countries would later adopt import substitution policies to reduce their dependence on foreign goods. While the Great Depression would last for much of the 1930s, the road to recovery was gradual. The New Deal provided vital programs that helped sustain the country during the worst years, but it wasn't until the outbreak of World War II that the U.S. economy truly began to recover. The war effort led to a massive increase in industrial production, creating jobs and boosting the economy. The U.S. government also invested heavily in defense spending, which further stimulated economic growth. By the early 1940s, the U.S. had fully recovered from the Great Depression and the country entered a new era of prosperity. As we look back on the 1929 stock market crash, it's clear that there are critical lessons we can learn for today's financial world. While we have made many advances since the Great Depression, the fundamental principles of sound financial practices and government intervention still hold true. 1. The dangers of speculation and over-leverage. One of the key lessons of the 1929 crash is the danger of excessive speculation. Just as investors in the 1920s borrowed money to invest in the stock market, today's investors must be cautious of over-leveraging themselves. Whether through margin buying or high-risk investments, it's crucial to recognize the signs of a market bubble before it's too late. 2. The importance of government regulation. The government's response to the Great Depression highlighted the importance of regulation in the financial markets. Today, financial institutions are more heavily regulated than they were in the 1920s. But the 2008 financial crisis demonstrated that regulatory bodies must remain vigilant in monitoring and addressing systemic risks. 3. The need for strong monetary policy. The Federal Reserve's role in preventing a collapse after 1929 teaches us the importance of effective monetary policy. Central banks must act swiftly during financial crises to prevent panic and provide stability. The lessons from 1929 continue to shape how central banks manage economic downturns. The Great Depression of the 1930s left an indelible mark on the US and the world. It reshaped the global economy, government policies, and the financial system. While many of the lessons from the crash have been incorporated into modern-day financial practices, the risk of another collapse remains. The hidden signals that preceded the 1929 crash serve as a reminder that financial markets are not invincible. By recognizing the warning signs, we can avoid repeating the mistakes of the past. It's essential to learn from history so that we can protect our wealth and ensure a more stable financial future. As we reflect on the events of 1929 and their long-lasting impact, one thing is clear: the 1929 crash was not an isolated event, but a culmination of overlooked financial data, speculative behavior, and systemic flaws. And while we cannot predict the future, we can learn from the past. Thank you for joining me on this deep dive into the 1929 stock market crash. If you've learned something valuable today, don't forget to like, subscribe, and hit the bell for more insightful financial breakdowns. Drop a comment below and let me know how you think we can avoid the same mistakes in today's markets. Until next time, stay financially savvy.